Ugh, I know, inflation, inflation, inflation. Well, I'm here to let you know that when it comes to inflation, the IRS just might be your friend. Well, somewhat. You might be surprised to know that when inflation is high, the IRS will increase the value of some tax credits and deductions. They do this so that during inflation, you shouldn't see a big difference in your tax refund or tax bill. There are some exceptions to this though. So today we're going to take a brief look at the effect of inflation on your federal income taxes. As I just mentioned, there are a lot of tax provisions that will adjust based on inflation. Some examples are the standard deduction, personal tax brackets, 401k contribution limits, and the earned income tax credit. For instance, although tax rates don't change, during inflation, the IRS might move taxpayers to a lower tax rate so they will pay lower taxes. This also helps to prevent bracket creep, which is when inflation pushes you into a higher tax bracket, causing you to pay more taxes without a real increase in your income. But there are some federal tax provisions that can lead to you paying more in taxes during inflation. We will take a look at 4 examples. First, the child tax credit is set at $2,000 through the end of 2025 and will be $1,000 after 2025. Since the child tax credit amount doesn't adjust, the credit becomes less valuable during inflation. Also, during inflation, the phase-out limits for being able to take the credit don't change, so you are less likely to qualify for the credit at all. Another example is capital gains. During inflation, you can end up with a net capital gain on an investment simply because there was a rise in inflation. We have seen this with the housing market. Although you might have an increase in the price of your home, you don't have an actual increase in spending power. So during inflation, if you sell your home or any other investment, the phantom increase in value could lead to you paying capital gains taxes, although you really didn't benefit from the increase in its value. At least the long-term capital gains tax brackets are adjusted for inflation. So hopefully your profit on the sale of your investments would be low enough to keep you at the lower capital gains tax rates. Okay, let's look at our third example, which is almost the same as the capital gains situation. If you are single and earn over $200,000, or if you are a joint filer earning over $250,000, you will be hit with an extra 3.8% net investment income tax on certain investment income. So on top of the capital gains tax, you would pay a net investment income tax, although you did not see a real increase in income during the inflationary period. Lastly, your business is also affected by inflation. As a business owner, you rely on depreciation to help reduce your taxable income, but in times of inflation, the current value of your depreciation deduction will be less than what the item originally cost. So due to the possibility of future inflation, whenever you purchase a fixed asset, there is more risk in depreciating it over a long period of time. Whenever you purchase a new fixed asset, the possibility of future inflation is one reason that you should always strongly consider taking as much immediate upfront depreciation as possible. Although it's great that during inflation, you don't have to worry about most federal tax provisions affecting your tax bill, please be sure to analyze your situation for the tax impact of the provisions that are not adjusted for inflation. Hopefully you can do some tax planning ahead of time to avoid an increase in your tax bill. All the best to you.